week, we've been discussing all of the great things that we do at Axos Bank. If you missed any of the prior webinars, don't worry. At the end of the series, we'll be sending you a list of hyperlinks so you can go back and review these webinars, share them with your colleagues, or just refresh yourself on all of the topics that we covered, which included DSCR, pledged assets, cross-collateralization. Today, we're going to be talking about asset depletion, amongst other things. So we've only got 30 minutes today. I'm going to be going very quickly. Please take notes, use the question box. Welcome, Norm, from New York City. Welcome, Patrick, in Calabasas. We appreciate you, and I hope that you find this valuable. Your AEs are tasked with helping you have better conversations with your strategic partners, realtors, CPAs, financial planners. How can we build relationships and create new opportunity using the niche programs that are available to you through your relationship with Axos? And that's really the key. As a differentiator, as an originator, I often talk about how, great rates and fast service are presumed by everybody. If you're going to remain competitive, you need to be not only efficient and able to close deals, but to provide solutions for your strategic partners where other originators may have been relying upon the low-hanging fruit of fixed conforming conventional loans. Portfolio jumbo is where we want to help you thrive. So for those of you that may not know, Axos Bank is the original bank of internet. We've been around for 20 years. We're about a $15 billion asset size. We specialize in portfolio jumbo and super jumbo. However, we do offer a variety of different programs that are available to you now at all different levels. We've always been known for a handful of products, asset depletion being one of them, pledged assets. I mentioned cross, I mentioned DSCR, of course, super jumbo loan amounts up to 30 million, bridge loans, pretty much anything that's outside of the box, you have the opportunity to bring to Axos. And today, specifically, we're going to be talking about the asset depletion program. And I want you to think about asset depletion as a solution to overcome debt-to-income ratio challenges. So when we're dealing with pledged assets, we're solving LTV issues. When we're using asset depletion, we're solving DTI issues. And we're simply converting a borrower's post-closing liquidity. And what I mean by that is after the down payment, after the reserves, all of those calculations are done in advance, and then the remaining post-closing liquidity, we are going to convert that into an income calculation. Now, I mentioned that the Axos Bank AE's commitment to you is to help you have new and better conversations with your strategic partners. And one I want to discuss today, a conversation starter, is what I call the asset depletion conversation. Now, you can have this with CPAs, financial planners, real estate agents. I would ask them this question. Are you working with any self-employed clients that have significant liquid assets in the bank in addition to their reported income? Now, you will note that many of the borrowers in today's day and age are not necessarily interested in submitting tax returns. They want to use bank statements for qualifying. They want to use assets for qualifying. And oftentimes, their reported income may not be a true reflection of their total picture. And as a portfolio lender, we understand that. And that's why we introduced this program. So as I mentioned, you'll convert their post-closing liquidity into a income calculation. And we're going to get to that in just a minute. It's important to know the assets that are required for asset depletion. You should always have a minimum of $500K in liquidity before the asset depletion conversation starts. Now, we do actually have an expanded product that I'm going to be talking about in a little bit here that allows for lower liquidity levels and lower loan amounts. But the primary focus for today's conversation is our portfolio jumbo. So we will use cash, CDs, securities, money markets, anything that's considered liquid, and then non-cash would be stocks, securities, etc. Those things take a 25% haircut, meaning I'm going to use 75% of the account's value. So let's say they had $1 million in Apple stock, 750 would be utilized towards the asset depletion calculation. We get a lot of questions about crypto. Now, crypto, we're looking at case by case. For those of you that have been living under a rock and don't know that we're in a crypto winter right now, the value of crypto is very challenging to establish. The ability for somebody to walk in and liquidate it and get their cash out tomorrow has changed. So we're going to look at that with a lot of scrutiny. But if somebody does have crypto as an asset and we can validate they are the owner, there may be a path to utilize that as well. It's very important to understand that the asset depletion qualification, it's an underwriting philosophy, if you will. It's not a specific loan program. We can use asset depletion across our portfolio products, whether they're full doc or bank statement. So as an example, if you had a bank statement qualifying borrower on the portfolio and you had a separate account that was not their business account that had a significant amount of liquidity in the account, then you could use that asset depletion on top of the bank statement qualifying that we're using from their business bank statements. Again, the important key is anytime that you have a borrower that you're challenged with their DTI, get on the phone with your Axos account executive, have a conversation with them, and see if there's a path to solve that DTI issue. Generally we'll go to 47 to 52 DTI. We'll make exceptions even up to 60, and oftentimes converting post-closing liquidity in an asset depletion calculation can solve many DTI issues. We always get the question, can you use retirement or 401k? If you've got a borrower that's 59 and a half or older, then yes, you can use those assets as part of their qualifying. So for those of you that are a little bit more visual, if you look at the right side of the screen, this is an example where a borrower's earnings are $5,000 a month, their DTI doesn't qualify, and they want additional income. They've got $1 million in post-closing liquidity. In this case, it's cash, so I'm going to use the full million for my calculation. And here's how we do it. We're going to subtract the borrower's age from 85, and that's going to give us the baseline numbers for amortization. So in this case, my borrower is 75 years old, so I'm going to use 10-year amortization. And then I'm just going to use a mortgage calculator and a nominal rate of 5%. So if I amortize that over, in this case, 10 years, the result is my borrowers now have $10,600 in additional qualifying income. So you would literally just list that on the application as other income, asset depletion, and then list $10,600. So now my borrower who previously only had $5K in income to work with now has $15,600. So it doesn't take long to figure out that you could purchase significantly more house with 15 grand a month than you could with 5 grand a month. So think about this in your conversations, again, with real estate partners, with financial planners, with CPAs. Anybody that has a significant amount of liquidity could utilize this on our portfolio products. And there's a couple of things to consider. The borrowers need to have unrestricted access to those funds. A lot of times, since we're a jumbo and super jumbo lender, we've got the proverbial trust fund babies. We did a recent transaction for an heir to a very famous, world-renowned singer, songwriter who had passed away, and the heir was receiving not only monthly income, but also had a sizable pool of money that was left to them. And we were able to apply an asset depletion calculation to that asset to allow them to qualify for their home purchase. A couple of other things to consider again, because it's an underwriting tool, it's not a separate loan program. If you need to use it in combination with other products, the only one that it won't work on internally is DSCR. We're solely relying on rents on that one. We're not using borrowers' income for those deals, but all other portfolio products, asset depletion is an option. I'm going to pause for a second. I'm going to remind you that the question box is open. You can use the chat or question box to send any along the way. And then I'll save some time at the end of this conversation to also do a little Q&A session. I've got a question in the box from Ray. Hi, Ray. Good to see you. Oh, hi, Franny. Glad you made it. Let's see. Is there an add to pricing if using asset depletion? No, on the portfolio, we do not add any pricing hit for using asset depletion. Now, it's important to understand this is a key distinction between our portfolio programs and the expanded products that we're going to talk about in just a minute. An asset depletion loan with Axos is a full doc loan. So that means the borrower's 2 prior years filed tax returns need to be in the loan. So even if they're not producing enough income to qualify for the loan, I still need to have them in the loan. And that's different than many lenders where they just say, only give me the assets and I don't care about whether you're filing returns. That's not the case at Axos. We need the returns in the file. However, we will make our income and our lending decision on the assets that are being utilized. And the key component there is we want to make sure that we don't have a borrower who has, multi-million-dollar losses that they have to fund with cash, and that cash is the money that they have in the bank that they're expecting to use for asset depletion. So just kind of keep that in mind. Additionally, I mentioned that this is post-closing liquidity. So you have to make sure that you've allotted for your reserves, for your down payment, for your closing costs before you apply the asset depletion calculation. And a couple other things that just know, again, as a portfolio lender, we are known to make exceptions for a variety of different things. DTI in some cases, LTV occasionally, not so much in the current environment just based upon the instability of values, but DTI exceptions. If you said, my borrower has $450,000 in their account versus $500,000, would we still apply an asset depletion calculation to that? Probably. If they've got a low FICO for some reason that's not based upon just poor credit management, then we will consider borrowers with lower FICO scores. So there's a variety of different ways that we can look at this. Just know as a portfolio lender, of course, we like borrowers with a lot of liquidity, low LTVs. Our standard guidelines are 70% to 2 million, 65 to 5 million. And then you can get to higher LTVs by crossing additional real estate, by pledging additional assets that might be separate from the asset depletion assets. So all of those things, again, can be combined to put deals together. As an example, they can be used, asset depletion can be used on any cash out refi, on any purchase transaction. Now, you can't take the cash out and apply an asset depletion calculation to that cash, but if you're doing a refi or a purchase, if it's investment property, second home, doesn't matter. Again, it's an underwriting tool to use on our portfolio products. Got another question in the question box from Max regarding retirement accounts. If I've got a 68-year-old borrower with $10 million in retirement, it can be used as 7.5 in net assets, yet only income is SSI and a 50 LTV. Absolutely. Upload that loan today. That's an Axos loan all day long. So we will give him, somebody wants to do the quick math. Let me just see what I can get done in my head. So if he's 85 years old, I subtract his age from 85. That's going to give me 17-year amortization. So if I was saying, okay, if I had 17 years amortization at 5% on 7.5 million, quick math is going to give him about 54 grand a month in qualifying income. So that is the number, on the number. Way to go, Ray. You got it. Let's do it. Let's bring that loan in. Let's see. And we love big loans, and we cannot lie. Here's an example of one that we closed in Maui. $7.5 million loan amount. It was a second home, 50 LTV. Now that smoking rate was because it was from July of 2021, but this was a 100% cash out deal at a 50 LTV, and their income to repay that debt was derived solely from asset depletion. Now again, you don't necessarily have to have asset depletion as your only income solution, but if needed, it's an option. Which reminds me that we have no cash out dollar limits. So as an example, if you've got borrowers that bought properties in 18, 19, 20, they've got a ton of liquidity as the markets rose and, a ton of equity, and they want to cash some of that out and park it on the sidelines, and they only have the ability to qualify with asset depletion, that's cool. No limits on the amount of cash out, just subject to our LTV restrictions. Okay, I mentioned that we also rolled out last year flexibility under our expanded products to be able to do lower loan amounts in some of the markets that are not super jumbo markets, right? And this product allows for asset depletion under two very specific circumstances, what we call our expanded prime and expanded non-QM. Now, the driver of that is DTI loan amount in FICO. Just on a side note, the minimum FICO on expanded is now 660. The 640 that you see under expanded non-QM has been reduced. But if you had somebody with no mortgage rates and no housing events in the last 4 years, and if they only had 6 months reserves, they're actually eligible for asset depletion. Now on expanded, that is a very different asset depletion calculation. It's literally take the entire asset and divide that by 84, and that's going to be the number that you use for qualifying income. No 4506, no tax returns as part of the submission, just a straight 84-month division of the total eligible assets. So if you've got lower loan amounts, or 3 million is not necessarily a lower loan amount, but on our portfolio we go to 30 million. So if you've got loan amounts greater than 3 million up to 30 million, portfolio is your only option. If you've got loan amounts 3 million and below, not any lower than 150, then expanded can become an option for you. And again, that's the key is anytime you have a borrower that needs asset depletion for qualifying, you want to be having a conversation with your account executive. At the end of this call, you'll have, of course, my contact information. You can always email or phone me, and then I will get you connected with your individual AE. So keep that in mind. And a few other things that we do, I saved a little bit of space. We claim Axos, right, to do what others won't. And that's really not just unique properties and unique programs, but if you're running into any of these scenarios out there in the world today, condo projects that don't meet Fannie Mae guidelines, you got properties with acreage, you've got I mentioned condo tail, if you've got multifamily and commercial, all of these programs and products are available to you through your relationship with Axos. So again, don't ever turn away a deal without having a conversation with your AE. And if you've got a borrower with significant liquidity and you're scratching your head, just connect with us. We'll walk you through the math. As I mentioned before, if you're taking somebody's age from 85, amortizing for the remainder, you never have to use more than 30-year amortization. So even if you've got a young borrower, let's say you've got somebody that's 20 years old, you're only going to use 30-year amortization on the asset. If you've got an elderly borrower, I use that term gingerly. So if you've got somebody, let's say was 80 years old, I would never use less than 5%, 5 years as my asset depletion calculation. So just a couple of things to keep in mind. I'm going to hit the question box again. This would be a great time, if you have any, to drop them in the question box. Again, I mentioned that you can always reach out to me if you're not able to track your AE down, or if you need an assignment of one. My email address is jshoop@axosbank.com. My phone number direct is 858-753-3157. We're here to help you structure deals, have better conversations with your strategic partners, and convert denied loans into funded loans. Okay, back to the question box. Reserves on the subject only or all REO? Great question, Ray. So for the reserve calculation, I'm only dealing with my subject property, okay? So currently when using asset depletion, I want to see 12 months reserves on the portfolio. I want to see 6 months reserves on expanded. And if I need to make a reserve exception, we're open to that. Again, if it's a temporary situation, let's say, for example, somebody just paid their kids' college tuition, somebody just paid their parents' real estate property taxes, and their liquidity is temporarily light, I'm going to be okay taking a look at that. Thank you. Next question from Bruce. Hey, Bruce, welcome back. What is the max LTV on a non-warrantable condo? So present guidelines, depending on what geography you're in, are 65 max LTV, sometimes 60 if it's cash out, 55 if you're in the tri-state area of New York, and if it's a condo, 50. Now, again, if you need higher LTVs on a condo, we can look at pledged assets, which we discussed yesterday. We can look at crossing additional real estate. So just know that if LTV is the barrier, have a conversation with your AE and let's walk through it. Okay, next question from Norm. Co-ops in New York City suburbs such as Nassau, where they are common in wealthy areas such as Great Neck, Rockville Center, etc. Yeah, we love New York. We love New York condos. We love co-ops in New York only. We are a little bit stingy with the LTVs in the current environment. And for those of you who don't know, if somebody doesn't pay you back in New York, it takes a significantly longer amount of time to recover your losses. And so we look at all of those case by case. But for high net worth borrower, lots of liquidity, bring them in. Okay, next question. Can a large value life insurance policy with cash value be used against the cash value? Patrick, I would take that one as a one-off, and it depends on what the definition of large is. So yes, cash value in a in a life insurance policy can be utilized as an asset depletion calculation, but I would want to understand the availability and liquidity of that value. How do they access it? What restrictions, if any, exist in their contract? And then secondarily, does anybody else have the right to those cash proceeds, right? Because if let's say a husband and wife, who's the policy against, who's it protecting, what's the purpose of the usage of that cash? We just want to understand it in its entirety. But remember, we're not liquidating any of that stuff. We're just applying a math equation to it. Same thing on the 401k and retirement accounts. They're not having to take the money out in order to use it for asset depletion. We're just saying, okay, here's the available math equation based upon the remaining balance after closing and based upon their age, et cetera. Great question. Let's see. Any other questions? I've got 6 minutes left here for Q&A, and then we're going to move on. I want to remind you that the recording links will be available at the end of the series, along with tomorrow, which we are going into tapping into the super jumbo market. So if you've got luxury real estate agents that you want to get to know better and to become the go-to resource for funding those deals, you're going to want to be on tomorrow's call. Again, as I mentioned, take your scenarios to your AEs. If you need to find your AE, send me an email, jfhoop@axosbank.com, 858-753-3157. We're here to support you. We're here to help you figure out new ways to generate new opportunities, to cement relationships with your strategic partners or create new ones, whether those are real estate agents, financial planners. Think about this. In the world of social media, and I've mentioned this in the past, your real estate agents, they're posting, they're doing their Instagrams, they're doing their TikTok videos. If they want to stimulate opportunity and lead flow based upon, quick hits, quick snackable content, if they mention to somebody, you've got a ton of liquidity or you've got a ton of assets and you want to buy a house, ask me how. If you're talking to the financial planner, as I mentioned, if they want to be a homeowner, but their reported taxes just don't allow them to get in the game, we want to talk to them, right? Again, the goal is to be a resource. I got another question in the question queue here. This is, can you expand on P&L program? Well, this is not necessarily the venue for that product, but I'll hit it really quick. So on our expanded program, the P&L does need to be prepared by a third party. On the portfolio products, you can have a borrower prepared P&L, but we might ask for the 12-month supporting bank statements to document the revenue. So any of those scenarios, again, just go direct to your AE, and then we can look at them case by case to see where they fit. Okay, we're down to the last couple minutes here. Again, if you've got questions, plug them in the question box, get them while I'm live. Otherwise, circle back with your AE or me, jshoop@axosbank.com, 858-753-3157. And I will fully expect to see all of you back tomorrow. Tell your colleagues to chime in. 30 minutes might just change their life. You fund a couple of unicorns. We've got deals in our pipeline right now at $15, $20, $30 million. I would love to be scratching out a commission check to you for one of those deals. We're in the final countdown, not seeing any other questions. Thanks again for taking the time out of your day. We appreciate you. Go fund some jumbo deals, and we'll see you tomorrow. Take care.